your number one fear in retirement is probably the fact that you might run out of money. However, if your way of fighting that is by just living off the interest that your portfolio is generating, then your portfolio may be at greater risk than you realize. In today's video, I'm going to show you why, and I'm going to show you a different approach that you should use instead. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. Now, if you ask the average retiree, what's the goal with your portfolio? Many of them would say, well, preservation of principal. I'm retired, I need something conservative, I need something that's going to be very stable because I can't risk it in the stock market. Now, why is that relevant? Well, things have changed quite a bit here in the last several months. For one, the Federal Reserve started drastically increasing interest rates in 2022. What does this mean? Well, it means if you go to the bank, or if you want a high yield savings account, or if you want a bond even, you're getting much higher rates of interest than you did several months ago. Now, these higher rates, the temptation is to say, oh, why would we invest our money in something that's volatile like the stock market when we can now get a secure rate of return of, call it 3%, 4%, maybe even more? Why don't we just park our money there and live off the interest? This is a very common thing that a lot of retirees are now doing. And so as we look at that, it seems as if these conditions have made investing easier. Now, let's assume you want to live on $40,000 per year in retirement and you have $1 million. Well, why not just go park that into a high yield savings account that pays 4% and live on that $40,000 per year? Your principal's in place, your principal's intact, so that $1 million stays stable, and it's going to generate $40,000 per year in interest. It seems as if it solved that puzzle for you. However, there's a huge amount of risk in this, and it's actually a very dangerous way to invest. The reason is inflation. So if you retire, and we go back to that example, and you say, I need $40,000 per year to live on, and I have $1 million. Well, if you put that $1 million into a high yield savings account or some bond that's yielding 4%, let's just assume for simplicity that you knew you could get that 4% every single year for the next 30 years. Wouldn't that make things easy? Well, this year it would, because this year you need $40,000 and this year you're getting $40,000. But what about 5 years from today, 10 years from today, 20 years from today? What happens then? Well, you're still receiving the same dollar amount in those years. Every year you're still receiving $40,000 per year, but your purchasing power is being diminished. Meaning that $40,000 is the same in nominal terms, but it's buying less and less and less every single year. Here's what I mean by that. After 5 years of inflation growing by 3%, you would actually need about $46,300 to maintain the purchasing power that you would have today with $40,000. So if you're still just receiving $40,000 per year, you're not receiving everything that you need to keep up with inflation. After 10 years, you'd need about $53,750 to keep up with inflation to maintain your purchasing power, but you're still just receiving $40,000 if you're just living on interest. After 20 years, you would need closer to $72,240. And finally, after 30 years, you would really need closer to $97,000 to maintain the purchasing power that you have today with $40,000 per year. So when we start to zoom out, we can see the tremendous risk that this presents. Today, it seems super stable. Park that $1 million, park whatever the amount is in something that's generating 4% or generating some interest in keeping the principal stable. But by doing that, what we're subjecting ourselves to is purchasing power loss. We're subjecting ourselves to risk of inflation over time because while that principal stays stable, while that interest stays stable, the cost of living is increasing and increasing and increasing. If we're not investing to keep up with that, then you're going to start to feel that more and more and more. And at some point, you're going to realize that interest isn't allowing you to do everything you want to do. And after 20 years, after losing almost half of your purchasing power, it's at that point you'll start to realize how risky it was to take the quote unquote safe option of just living off interest today. So what should we do as investors? Well, the first thing I'd propose is reframing the way that we view risk. If we view risk as volatility, so the fluctuation in the value of your investments in the short term, which is, by the way most people view risk, then the most conservative thing we can do is put our money into cash, into bonds, into really stable investments where we have some type of guarantee or a high degree of certainty that those investments will remain stable. However, if we look at risk as the permanent loss of purchasing power, then we can start to see how cash, how bonds, how conservative investments are one of the most risky things you can do with your money over time. So what do you do instead? Again, you change your perspective. The goal of investing in retirement should not be preservation of principal, it should be growth of income. How do we have an income stream that we're not going to outlive over the course of our retirement? So instead of looking at cash now or stable investments, let's look at stocks. And when you think of stocks, and you think of stocks in retirement, most people think of it in the same way they might think of going to Las Vegas and gambling. They think, wow, you could make a lot of money, but you could also lose a tremendous amount of money. That's not the right way to look at it. Now, granted, you need a well-diversified portfolio, you need a strategy, but here's how I want you to look at stocks. What if 30 years ago, you had taken that $1 million and instead of putting it into an interest-bearing CD or a high-yield money market account, what if instead you'd put it all into the S&P 500? This is not a recommendation. I don't think that's the best strategy. In fact, I know it's not the best strategy for most people, but just hypothetically, what would have happened? Well, we've been through 4 major bear markets since then. 2 of them where the S&P lost about 50% of its value or more. But what would have happened to your money? Well, if you parked that $40,000 in the S&P 500 in 1993, if you took $40,000 out per year and adjusted that for inflation, today you would have about $8.5 million in your portfolio. So unlike the prior example, where you had to live on $40,000 per year if it was in a high yield savings account and that remained fixed, and you still had your $1 million that was stable, in this example, you accepted some risk, as most people call it, by fluctuations in your portfolio, but you received an inflation adjustment on your $40,000 per year every single year. And on top of that, your $1 million has turned into about $8.5 million since that time. And by the way, that $8.5 million, that's after those withdrawals. So that's me factoring in the fact that you're taking $40,000 out per year to live on. But to me, that's the boring part. The boring part is $1 million turning into $9 million. And I say that kind of tongue in cheek. Of course, that's exciting. But here's what's really exciting about investing in the stock market. Again, when we can reframe this from, okay, this is just a casino, this is just a wild hope, this is just something that we're doing in hopes of a better future. Well, look at this. Understand that when you're investing in the S&P 500 or when you're investing in stocks, you're owning real companies. And these real companies are innovating, and these real companies are creating new products and new services. And these new companies or these companies are doing amazing things to grow their profits and to grow their revenues and to grow their services every single year. Well, if you go way back to 1960 and just look at the S&P 500, the companies in the S&P 500 at that time, the dividend on that index was about $1.98 per year. So you had that as a dividend, as a cash dividend in your portfolio. Now, if you take that same index and fast forward to today, the cash dividend on that today is about $68.34. So when you look at that, over the last 62 years, the growth on the dividends has been about 5.8%. So again, instead of looking at stocks as these things that go way up and way down in value, if you look at these as cash generating machines, that cash is what you live on, but not only are you living on that, the growth on that dividend has been just shy of 6% since 1960. Compare that to inflation over that time, that's been about half of that, and you can start to see how yes, stocks do have volatility, and yes, there are absolutely risks to stocks, but if the goal of our portfolio is growth of income, not necessarily preservation of principal, then what you start to see is that can be a wonderful way to invest as you're looking to create an income stream that you won't outlive over the course of your retirement. So what's the takeaway from all this? Well, the takeaway is if your main goal is preservation of principal, you're probably going to feel okay for the first few years of retirement. The real risk, though, is the middle and the latter years of retirement. What starts out feeling okay, starts to get a little tight, and then gets downright scary towards the end of retirement as you realize your money hasn't grown enough to keep up with inflation. However, if instead of viewing the goal of our portfolio as preservation of principal, and instead start to focus on creating an income stream that's going to rise over time to keep up with inflation, that's where we can start to see that the quote-unquote safe investments are quite risky long-term, and the other investments, like stocks, that are typically thought of as risky, if we can invest the right way, can be one of the best things that we can do for ourselves. In fact, one of the least risky things we can do for ourselves when we have a long enough time horizon. And the reality is, by the way, you don't want to put 100% of your money in the S&P 500. That's just big domestic US stocks. You also want to own some small stocks, some international, some real estate, some emerging markets. You do want to have some in cash or bonds. The reality is you should look at your financial goals, your financial needs, construct a plan, and then understand what's the right mix of investments that will help me to best accomplish this plan. It's not going to be all conservative, stable stuff. It's also probably not going to be 100% S&P 500. But having the right mix for you is a much safer way of approaching investing in retirement. Now, if you're watching this and thinking, wow, that dividend growth rate, that's wonderful. How do I do more of that? Well, if you want to know what's the least amount of money you need in your portfolio to fully live off dividends, be sure to check out this video here. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.